We're analyzing Intel, stock ticker INTC, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Intel. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Intel for your portfolio. Before we get into these valuable metrics, let's understand Intel's stock performance. Right now, Intel trades for $28.87 per share. In the last year, their stock price is down 37%. They're underperforming the S&P 500. In the last 5 years, Intel's stock price is down 43.5%. This is a decline of 11% annually. In the last 10 years, Intel's stock price is compounding at 3% annually. Going back prior to the global financial crisis, in the last 18 years, Intel has only compounded their stock price at just under 2% annually. So their stock price is up 35% overall. Intel has paid out dividends throughout this time. Right now, Intel has a high 4.9% dividend yield. Although they did announce a dividend cut, their average dividend yield throughout this time is in addition to these compounded annual returns in their stock price. Intel trades just $4.50 above their 52-week low. The company has been nearly cut in half from their 52-week high. Just under 2% of their shares are sold short. Intel is a large business. They have a nearly $123 billion market cap. But why should we be paying close attention to Intel? Intel is the world's largest logic chip maker. It designs and manufactures microprocessors for the global personal computer and data center markets. Intel pioneered the x86 architecture for microprocessors. It was the prime proponent of Moore's Law for advances in semiconductor manufacturing, though the firm has recently faced manufacturing delays. While Intel's server processor business has benefited from the shift to the cloud, the firm has also been expanding into new adjacencies as the personal computing market has stagnated. These include areas such as the Internet of Things, artificial intelligence, and automotive. Intel has been active on the merger and acquisitions front, acquiring Altera, Mobileye, and Habana Labs in order to bolster its efforts in non-PC arenas. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are two key reasons for this. The average publicly listed business earns about a 7% return on capital. Over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. Looking for a benchmark that's double this allows us to potentially build in some margin of safety based off the overall quality of the business. Intel's return on capital has tanked over this 5-year time frame. It's declined in all 5 of these years. It was very poor in their fiscal 2022. They earned just 1.6%. Even still, averaged out over these last 5 years, Intel earns about 16% average returns on capital. This is a check on metric number 1, though this is something you want to be mindful of. Metric number 2, we're taking a high-level overview of the growth of Intel. We're looking for revenue, net income, and free cash flow growth in the last 5 years. This metric is all or nothing. All 3 of these have to be up for this to be a check. Intel's been hit across the board here. Their revenues have declined by 11%. Their earnings are down 62%. And their free cash flows, which were positive in 4 of these 5 years, are negative in their most recent fiscal year. There are a number of contributing factors here to Intel's poor performance. It starts early with lower revenues, it continues with higher cost of goods sold, and then the business is also investing more in their capital expenditures. Intel's cost of goods has increased by $9 billion in this time, and their capital expenditures have increased by $10 billion as they're investing in fabs. This is added on to top-line declines for Intel. This is an X on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder and looking for earnings per share growth in the last 5 years for Intel. In this time, Intel's earnings are down 62%. At the same time, Intel's bought back about 12% of their shares outstanding. They've repurchased about 1/8 of the company. This is a potential good sign for long-term shareholders in Intel if you believe that the company's future looks better than its recent past. When you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a company buys back its shares by decreasing the number that they have outstanding, they're increasing your ownership percentage in the business, which will increase your percentage of the business's profits without you having to spend a dime. It's almost as if the company is making a partial acquisition of itself. Just like with any other acquisition, we want the business to be getting more value than the price they're paying. This depends on a couple of factors, including the price these buybacks occurred at and what an estimate of Intel's fair intrinsic value is, which we'll cover later in the video, so you'll want to stay to the end. Again, Again, with their earnings down so massively, this is an X on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years for Intel. Their free cash flows have gone from being positive to negative over this time. Even with these share buybacks, this is a similar story. It's another X on metric number 4. Recapping where we stand currently, through our first 4 metrics, we only have one check for Intel. Metric number 5, we're evaluating how Intel uses debt. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. To check if this is the case, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow Intel has produced in their last 5 years. Intel currently has $12.8 billion in net debt. Over this time, even though their free cash flows have declined by so much, Intel still managed to produce $52 billion worth of free cash flow. This is more than 4 times their debt loads. Intel historically has been strongly cash flow generative relative to the debt they're employing, meaning this is a check on metric number 5. While it's a different story in their most recent fiscal year, again, Intel has increased their capital expenditures by more than $10 billion in the last 5 years alone, at the same time that their top line revenues are down. That's a contributing factor to their free cash flow woes, which again, you need to understand the growth prospects of Intel into their future to understand if this will change or not. Through 5 metrics, we have 2 checks and 3 X's on Intel. Before we get to metric number 6, we can't forget about our bonus. As our bonus, we're looking at Intel's dividend profile. Currently, Intel pays that high 4.9% dividend yield, though they have announced dividend cuts recently. People make mistakes all the time by blindly chasing dividends. It's important to stop and look at the underlying fundamentals of a business to see if they're able to support their dividend payouts. Intel has supported a growing dividend in 4 of these 5 years with their free cash flows. With negative free cash flows in their most recent fiscal year, they were not able to support a growing dividend, even though they did increase their dividend, which is a controversial and probably not that great of a rational capital allocation decision. While this is a snapshot of their last 5 years of performance, and it's no guarantee for the future, Intel currently does not support their dividends using their free cash flows. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will provide a slight risk premium to the yield of the 10-year treasury. It may offer a reasonable starting point for a fair value of Intel. We're using their total enterprise value as it takes into account both their market cap and their net debt position. It gives a perspective of Intel that's more similar to it being a private company. Right now, Intel has a $137 billion total enterprise value. In the last 5 years, we learned the business produced $52 billion worth of free cash flow, meaning in an average year, Intel produces about $10.4 billion worth of free cash flow. When we divide that by their $137 billion total enterprise value, that gives about a 7.5% average free cash flow to enterprise value yield. On a current basis, Intel has a negative free cash flow to enterprise value yield. Free cash flows can be lumpy year to year, which is why we're using an average here. Intel's average is coming in a couple of percentage points above the risk premium we'd be seeking. This is a check on metric number 6 for Intel. Just because this is the case doesn't mean you run out and go buy the business. This is not financial advice. It's not a buy or sell recommendation of any security. You'll want to stick around as we come to a more concrete estimate of Intel's fair intrinsic value before giving our rating to the business. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Intel, which takes us on to using a discounted cash flow model to come to an estimate of a fair intrinsic value for Intel. A DCF model is based off the predictability of a company's free cash flows. It's like any model in any discipline, its outputs will be sensitive to its inputs. Here we're starting with an average of Intel's free cash flows in their last 3 years, and using historical growth assumptions to grow these into the future. It's up to you to do your own homework. If we assume Intel grows their free cash flows at a rate of 5% annually for the next 10 years, then these grow at 4% annually in the 10 years from there. If we add in the company's tangible book value, which gives us an estimate of their tangible net worth, and we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements. At today's valuation of Intel, an estimate of their fair intrinsic value is around $30.50 per share. That's just about $1 above the company's current stock price. There are key factors to keep in mind. Intel has had a low degree of predictability in its past, especially in their most recent decade. This impacts our assumptions. Intel has also had a very rough showing in their fiscal 2022. This is why the analysis is updated so drastically from what it was just last year. Intel's 4.9% dividend yield would be included in this discount rate. We would not be doubly counting their dividends. Their tangible book value may also be understated due to their share buyback. buybacks. These are all things to be mindful of here. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, consult with your financial advisor. In just a minute, we'll give our rating to Intel, but we have to address something first. What are the qualitative aspects of the business? Starting with the qualitative factors supporting a potential long thesis. Number 1, the data center group has indirectly benefited from the proliferation of mobile devices. Server processor sales will be the main driver of growth in the near future. Number 2, Intel has made a string of savvy acquisitions to build its AI and automotive offerings, including Altera, Mobileye, Habana Labs, and Movidus. Number 3, Intel is one of the largest semiconductor companies in the world and holds the lion's share of the PC and server processor markets. The firm has maintained its position at the forefront of technology by investing heavily in R&D, and this trend should continue. Then for the qualitative aspects supporting a potential short thesis. Number 1, the rise of alternative solutions in the data center is cause for concern, with NVIDIA's GPUs being leveraged to accelerate server and AI workloads. Number 2, the inability for Intel to break into the smartphone market at a reasonable level is cause for concern, as mobile devices continue to proliferate at the expense of PCs. Number 3, most importantly, Intel is facing significant manufacturing delays and must maintain its process technology competitiveness to prevent market share loss to rivals such as AMD. There you have it for a balanced perspective of some of the qualitative factors of Intel. Now it's time to give our rating. In analyzing Intel Corporation, stock ticker INTC, we learned the business earns above average returns on capital of about 16%, even if they plummeted in the last 5 years. The company's revenues, earnings, and free cash flows are down in the last 5 years, but Intel has bought back 12% of their shares outstanding. The company has produced enough free cash flow historically to cover their debt loads, even if their free cash flows are negative in their most recent fiscal year. On an average basis of their free cash flow to enterprise value yield, Intel was coming in at nearly twice the yield of the 10-year treasury, and above that slight risk premium. Again, their current yield is negative. Intel supported a growing dividend in 4 of the last 5 years. They did not and do not currently support their dividends. It's worth reiterating, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any investment decision, consult with your investment and financial advisors. Combining all the factors of our analysis, Intel looks like a moderate candidate for further research. The company had a rough showing in their fiscal 2022. The question's still open: will Intel reclaim its former glory? Performing a discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions from today's valuations of Intel, an estimate of their fair intrinsic value is around $30.50 per share. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for joining me for an update on Intel, and have a great day.